In a leased warehouse in Florida, in the final weeks of 1997, boxed barbecue grills sit stacked on pallets. Sunbeam Corporation has already recorded them as sold. The invoices went to retailers who did not order them for that quarter, who took no delivery, who bore no risk of loss on the merchandise. The grills remain in storage, and Sunbeam pays for the storage. On the earnings call, the company's chief executive tells analysts the turnaround is ahead of schedule, and the stock responds. The question this episode answers is narrow and specific. How does a company book revenue on goods that never leave its own control? And what accounting rule did it have to bend to do it? The mechanism at the center of the Sunbeam case is called bill and hold. It is not, in itself, fraudulent. It is a legitimate revenue recognition arrangement with a long history in commercial practice, and understanding why it exists is the first step in understanding how it was abused. A bill and hold sale occurs when a seller invoices a customer for goods but retains physical possession of them, delivering at a later date. There are ordinary business reasons for this. A customer may lack storage space. A customer may want to lock in a price or secure supply ahead of a seasonal peak. A buyer of custom equipment may need the manufacturer to hold the finished product until the buyer's own facility is ready to receive it. In each of these cases, a real transaction has occurred. The buyer wants the goods, has committed to pay for them, and has asked the seller to hold them as a convenience. The accounting question is when the seller may recognize revenue on such an arrangement. Revenue recognition turns on a single structural principle. Revenue is earned when the risks and rewards of ownership have passed from seller to buyer. In an ordinary sale, that passage is marked by delivery. The goods leave the warehouse, the buyer takes possession, and the transaction is complete. Bill and hold breaks the link between delivery and the transfer of ownership. So the accounting profession, and later the Securities and Exchange Commission, establish conditions that must all be satisfied before a seller may book revenue on goods it still physically holds. The SEC's criteria, developed through enforcement actions predating Sunbeam and articulated in accounting and auditing enforcement releases, are specific. The record shows the following requirements. The risks of ownership must have passed to the buyer. The customer must have made a fixed commitment to purchase, preferably in writing. The buyer, not the seller, must have requested that the transaction be on a bill and hold basis, and the buyer must have a substantial business purpose for that request. There must be a fixed schedule for delivery, and the date must be reasonable and consistent with the buyer's business purpose. The seller must not have retained any specific performance obligations such that the earnings process is incomplete. The goods must be segregated from the seller's inventory and not available to fill other orders, and the product must be complete and ready for shipment. Read those conditions together and a pattern emerges. Every one of them is designed to answer a single question. Has a genuine sale actually happened, or is the seller manufacturing the appearance of one? The requirement that the buyer initiate the request prevents a seller from pushing goods onto customers who do not want them yet. The requirement of a fixed delivery schedule prevents open-ended parking of inventory. The requirement of a substantial business purpose on the buyer's side prevents arrangements that exist only to serve the seller's reporting calendar. The requirement that the risk of loss transfer prevents a seller from retaining, in economic substance, everything it purports to have sold. bill and hold, in other words, is legitimate precisely to the extent that the sale is real and the holding is incidental. It becomes a vehicle for fraud when the relationship inverts, when the holding is the point and the sale is the fiction constructed to justify it. This is the structural distinction the Sunbeam case turns on. The SEC's enforcement action, filed against the company's former officers, did not allege that bill and hold accounting is impermissible. It alleged that Sunbeam recorded bill and hold sales that failed the criteria. The customers had not requested the arrangements. The customers had, in many cases, no business purpose for taking goods they could not use for months. The goods were seasonal products, grills, and outdoor cooking equipment, invoiced in the fourth quarter and in early 1998 for delivery far outside the relevant selling season. Retailers do not stock barbecue grills in January because they cannot sell them in January. The economic substance of ownership had not passed. Sunbeam retained the risk, and Sunbeam, not the buyer, drove the arrangement. To understand why the company reached for this device, you have to understand the pressure it was under and who was applying it. Albert Dunlap arrived at Sunbeam in July 1996 as chairman and chief executive. He came with a public reputation built on aggressive cost reduction at prior companies, a reputation he had cultivated and monetized. The market expectation attached to his appointment was explicit. He was hired to execute a turnaround, and the stock had already risen on the announcement of his hire. That expectation created a structural problem. A turnaround to satisfy the market must show not only reduced costs but growing revenue. Cost cuts have a flaw. You cannot cut below zero. Revenue growth is what sustains a stock's climb after the initial restructuring gains are booked. The record established by the SEC's enforcement action describes what followed. In its complaint, the Commission alleged that beginning in the last quarter of 1996 and continuing through the first half of 1998, Sunbeam's management engaged in a scheme to create the impression of a successful restructuring by using improper accounting techniques to inflate results. Bill and hold was one technique among several. The others matter because they reveal the shape of the whole. Consider the sequence in order. Step 1 occurred at the very start, in the fourth quarter of 1996, before the revenue inflation began. The company took a large restructuring charge. The SEC found that Sunbeam created excessive reserves and accruals as part of this charge and improperly recognized other items. A restructuring charge is a one-time recognition of the costs of reorganizing a business. It is booked against earnings in the period taken. What the record describes is the creation of reserves larger than the actual anticipated costs. This matters structurally because reserves established in one period can be released in a later period. When a reserve is reversed, it flows back into income. A company that over-reserves in a bad quarter, a quarter the market has already forgiven as the trough of a turnaround, creates a reservoir of future earnings it can tap at will. Accountants have a name for this practice: cookie jar reserves. The oversized 1996 charge was the cookie jar. It funded the appearance of recovery in 1997. Step 2 was the recognition of revenue that did not belong to the period. This is where bill and hold enters, but it did not enter alone. The SEC found that Sunbeam recorded revenue on sales that did not meet the criteria for recognition, including bill and hold sales and sales subject to undisclosed right of return and consignment terms. Each of these is a different failure of the same principle. In a consignment arrangement, the goods sit with a distributor, but title and risk remain with Sunbeam until the distributor sells them onward. Recognizing revenue on consigned goods records a sale that has not occurred. In a sale with an undisclosed right of return, the buyer can send the goods back, which means the risk of ownership has not truly passed. Booking such sales at full value without adequate reserves for returns overstates revenue. The bill and hold sales sat at the extreme end of this spectrum because in those transactions the goods had not even left Sunbeam's possession. The company invoiced retailers for seasonal merchandise, recorded the revenue, and then held the goods in its own facilities or in leased third-party warehouses at its own cost and its own risk. The SEC's findings describe discounts and incentives offered to induce customers to accept these arrangements. That is the tell. When a seller must pay a customer through discounts or extended payment terms to accept a bill and hold arrangement, the buyer's independent business purpose is absent by construction. A buyer who genuinely wanted goods held would not need to be paid to want it. The inducement is evidence that the demand was manufactured. The practice compounds the further you push it. This is the third structural feature: acceleration. Every dollar of revenue pulled forward from a future period into the current one is a dollar that will be missing from the future period. To hold reported revenue flat, next quarter must pull forward at least as much. To show growth, next quarter must pull forward more. Bill and hold and its cousins are borrowing mechanisms. They borrow from tomorrow's sales to pad today's. And like any borrowing, they must be repaid or refinanced with ever larger borrowing. A revenue acceleration scheme has an internal engine that requires it to grow. It cannot hold steady. It can only expand or collapse. The SEC's complaint quantified the effect. According to the Commission's findings, Sunbeam's reported 1997 results were materially overstated. A substantial portion of the company's reported income for that year did not reflect genuine, period-appropriate sales. The specific mechanisms varied by quarter, but the direction was constant. Results borrowed from the future were reported as achievements of the present. Now, hold the org chart in your mind. At the base, the 1996 restructuring reserve, oversized, functioning as a store of releasable income. Above it, a set of revenue recognition techniques, each violating the risk transfer principle in a different way: consignment sales, right of return sales, and bill and hold sales, ordered roughly by how far each strayed from a real transaction. Feeding those techniques, a set of customer inducements, discounts, and extended terms that manufactured the appearance of demand. And driving the whole apparatus, the market's expectation of a turnaround, which required not just cost cuts, but visible, accelerating revenue growth. The bill and hold grills in the Florida warehouse are the clearest single image of the scheme because they are physical. You can walk into the building and see the merchandise that has been sold on paper but has not moved. But structurally, they are one expression of a single distortion repeated across the company's revenue: the separation of reported sales from real economic activity. The next question is the one that every fraud case eventually forces. If the scheme was this systematic, why was it not caught sooner? Sunbeam was a public company. It had an independent auditor. It filed audited financial statements. Analysts covered it. Where did the verification chain fail? Start with what auditing is and is not. An audit is not a guarantee that financial statements are correct. It is an examination designed to provide reasonable assurance that the statements are free of material misstatement, conducted according to professional standards. The auditor tests, samples, and evaluates. The auditor relies at many points on representations from management and on the design of the company's own controls. This reliance is not a flaw in auditing, it is inherent to it. No audit reperforms every transaction. The structural weakness is that a management determined to deceive and willing to construct documentation to support the deception is operating inside the very system the auditor depends on. Bill and hold accounting presents a particular audit challenge because the transactions can be made to look valid on their face. There is an invoice. There is a shipping arrangement, even if delayed. There may be customer correspondence. The auditor's task is to determine whether the substantive criteria were met, whether the customer requested the arrangement, whether there was a genuine business purpose, whether the risk of ownership passed. These are judgments about economic substance, not about whether the paperwork exists. The paperwork can exist and the substance can be absent. Detecting the absence requires the auditor to look past the documents to the reality, to ask why a retailer would take title to grills in the winter, and to be unsatisfied with the answer. The record of what the auditor knew and when became a central part of the litigation that followed Sunbeam's collapse. The SEC brought an enforcement action against the engagement partner on the Sunbeam audit. That proceeding was resolved. Without restating the contested particulars, the structural point the case illustrates is this. The failure was not that the fraud was invisible, but that the indicators of it were treated as acceptable when they should have prompted the auditor to demand more. The presence of large quarter-end bill and hold sales of seasonal goods growing in volume is exactly the pattern that the SEC's bill and hold criteria were written to flag. An auditor applying those criteria rigorously would have had to confront the question of business purpose, and the answer, in the case of out-of-season grills held at Sunbeam's own expense, does not survive scrutiny. Consider what would have had to be true for detection to occur earlier. First, the auditor would have had to treat the bill and hold criteria as substantive tests rather than checklist items. It is possible to confirm that an invoice exists, that goods are segregated, that a delivery date is scheduled, and still miss the fraud, if one does not independently probe whether the customer wanted the arrangement and had a reason to want it. Second, someone in the verification chain would have had to notice the pattern across quarters, the accumulation of goods in warehouses, the recurrence of end-of-period revenue spikes, the growth in receivables relative to genuine shipments. Individual transactions can be rationalized. The pattern is harder to explain. Third, the analysts covering the company would have had to look behind the reported revenue growth to the balance sheet evidence that something was off. That balance sheet evidence existed, and it points to the most important structural principle in detecting revenue fraud. Revenue can be manufactured on the income statement more easily than the consequences can be hidden on the balance sheet. When a company records a sale, it records a corresponding asset. If the sale generates real cash, cash rises. If the sale is on credit, accounts receivable rises. If the goods were shipped, inventory falls. But when a company books bill and hold sales on goods it still holds, a peculiar signature appears. Revenue rises. Receivables rise because the customer was invoiced, but inventory does not fall as it should because the goods never left. and cash does not follow revenue because the manufactured sales do not collect on a normal schedule, and in some cases will never collect at all because the goods will be returned. This divergence between reported earnings and cash flow is the single most reliable indicator of revenue manipulation. A company can inflate net income. It cannot as easily inflate the cash in its bank account. When earnings rise and cash from operations does not follow, when receivables and inventory both swell relative to sales, the gap is a warning that reported revenue is not converting into economic value. In Sunbeam's case, the signature was present. The company reported a turnaround while its cash generation and its inventory and receivable balances told a different story. The information required to detect the fraud was contained in the financial statements the company itself filed. What was missing was not data. What was missing was verification willing to act on the discrepancy. There is a further structural point about analysts. Sell-side analysts covering a company are not auditors and do not have access to the company's internal records. They work from public filings and from management guidance. When a chief executive with a public reputation for turnarounds tells analysts the recovery is ahead of schedule, the reputation itself becomes a form of assurance that substitutes for analysis. This is a recognized structural weakness. A credible narrator reduces scrutiny. The market's willingness to believe the turnaround was itself part of the mechanism, because it lowered the threshold of skepticism at exactly the moment skepticism was most warranted. So the detection failure was not a single point. It was a chain in which each link relied on the one before it. Management represented the sales as valid. The audit did not sufficiently probe the substance behind the representations. Analysts relied on reported results and management guidance, and the market relied on analysts and on the executive's reputation. Each link was individually explicable. Together, they allowed a scheme with a visible balance sheet signature to persist through multiple reporting periods. The scheme unraveled the way revenue acceleration schemes structurally must. It ran out of future to borrow from. Recall the engine. Each period's pulled forward revenue leaves a hole in the following period. To fill the hole and show growth, the next period must pull forward more. The volume of manufactured sales must increase quarter over quarter. But the supply of customers willing to accept bill and hold grills, even with discounts, is finite. The warehouse space is finite. And the unshipped inventory, sold on paper, eventually has to be dealt with. At some point, the borrowing cannot be refinanced, and the accumulated deficit becomes visible all at once. The first sign came in the numbers the company itself had to report. As the manufactured revenue of prior quarters left its holes, and as the customers who had accepted goods under right of return terms began to return them, Sunbeam's actual results deteriorated. The SEC's account describes a period in early 1998 when the company's reported performance began to fall short of the expectations its own inflated prior results had created. The turnaround narrative required continuous acceleration, and the acceleration could not be sustained. In April 1998, Sunbeam announced results that disappointed the market. The stock, which had climbed on the turnaround story, fell sharply. This is the point at which the internal logic of the scheme became a public problem. A company that has borrowed from the future must eventually report a period in which the future arrives depleted. The market's reaction to that period is severe precisely because it contradicts the narrative the earlier periods had built. Scrutiny intensified. Questions were raised about the quality of the reported revenue and about the practices behind it. The board of directors, confronting the deterioration and the concerns about the company's accounting, acted. In June 1998, Sunbeam's board terminated Dunlap. The chief executive, whose reputation had substituted for analysis, was removed by the same board that had hired him on that reputation. What followed was the formal accounting reckoning. Sunbeam restated its financial results. A restatement is the mechanism by which previously issued financial statements, found to have been materially misstated, are corrected and reissued. The restatement is the moment the manufactured revenue is formally removed from the record. In Sunbeam's case, the restatement reversed a significant portion of the income the company had reported during the period of the scheme. The bill and hold sales that failed the criteria were reversed. The improperly recognized consignment and right of return sales were reversed. The releases of the excess restructuring reserve were unwound. When the borrowed revenue was returned to the periods it had been taken from, the reported turnaround substantially disappeared. The Securities and Exchange Commission conducted its investigation and, in 2001, filed an enforcement action. The Commission's complaint named former senior officers of the company and the audit engagement partner. It set out the scheme in the terms this episode has described. The excessive restructuring reserves that functioned as a cookie jar, the improper revenue recognition including bill and hold sales that failed the SEC's own criteria, and the resulting material overstatement of the company's financial results. The Commission charged violations of the anti-fraud, reporting, record-keeping, and internal controls provisions of the federal securities laws. The resolution of the matter is part of the public record. The SEC's action against Dunlap was settled. Under the terms of the settlement, and without his admitting or denying the Commission's allegations, Dunlap agreed to pay a civil penalty and agreed to a bar from serving as an officer or director of a public company. The officer and director bar is a specific and consequential remedy. It does not concern money. It removes the individual from the position where the conduct occurred. For an executive whose career was built on serving as a public company chief executive, the bar is the structural end of that career. The bankruptcy that followed was the economic conclusion. Sunbeam had taken on substantial debt during the Dunlap period, including debt raised to finance acquisitions made at the height of the inflated results narrative. A company that appears to be growing can borrow on favorable terms and can use its elevated stock to acquire other companies. When the growth is revealed to be manufactured, the debt remains real while the earnings that were supposed to service it evaporate. Sunbeam filed for bankruptcy in 2001. The company that the accounting had presented as a successful turnaround did not survive the correction of that accounting. What does the Sunbeam case establish about the mechanism? First, it establishes that bill and hold accounting is a stress test of a company's revenue recognition integrity. The legitimate use of bill and hold is narrow and defined by criteria that all point to a single question: is the sale real? Every one of the SEC's conditions exists to prevent a seller from recording revenue on goods the buyer does not yet genuinely own. When those conditions are treated as a checklist to be documented around rather than as substantive tests of economic reality, the device becomes a mechanism for recording sales that have not economically occurred. The distinction is not in the form of the transaction, it is in whether the risks and rewards of ownership have actually passed. Second, the case demonstrates the internal dynamics of revenue acceleration. A scheme that pulls revenue forward from future periods is not a static distortion. It is a debt that grows. Each period must borrow more than the last to maintain the appearance of growth until the supply of future revenue to borrow against is exhausted and the accumulated deficit surfaces at once. This is why such schemes tend to end in a single sharp collapse rather than a gradual decline. The mechanism has no equilibrium. Third, the case demonstrates that revenue fraud leaves a balance sheet and cash flow signature that the income statement cannot conceal. Manufactured revenue does not convert to cash on a normal schedule and leaves inventory and receivables swollen relative to genuine activity. The divergence between reported earnings and operating cash flow is the most durable evidence of the distortion. In Sunbeam's case, the information required for earlier detection was present in the company's own filings. The failure was of verification, not of available data. The regulatory consequence was concrete. The Sunbeam case, together with contemporaneous revenue recognition failures at other companies, contributed to a sustained regulatory focus on the timing and substance of revenue recognition. It reinforced the SEC's articulation of bill and hold criteria and the principle that revenue recognition must reflect the transfer of the risks and rewards of ownership. That principle, that revenue is earned when control genuinely passes and not before, remained the organizing idea through the subsequent evolution of revenue recognition standards. The forensic finding is this: Sunbeam did not fail because its executives were reckless with the truth in some general sense. It failed because a specific accounting device, legitimate within narrow limits, was deployed outside those limits to record sales that had not economically occurred, and because the mechanism of doing so contained an engine that required it to grow until it could not. The grills in the Florida warehouse were sold on paper and held at the company's expense. The distance between those two facts, between the reported sale and the merchandise that never moved, is the precise measure of the fraud.